The observation that income is received and then entirely spent before the next payday is a common phenomenon in personal finance. This experience, often described as living paycheck to paycheck, is not necessarily tied to a specific income level. It's a situation where outflows consistently match or exceed inflows within a given period. To understand this cycle, it's helpful to examine the fundamental components of a personal budget: income and expenses. Income represents all the money flowing into a household, while expenses are all the money flowing out. When these two are in near perfect balance, the result is a zero or near zero balance at the end of the month. A primary factor contributing to this financial state is the presence of fixed expenses. These are recurring costs that are generally predictable and consistent each month. Examples include housing payments like rent or a mortgage, utility bills such as electricity and water, insurance premiums, and loan repayments for cars or education. Because these costs are often contractual and non-negotiable in the short term, they form the bedrock of a monthly budget. They claim a significant portion of income before any discretionary spending can even be considered. For many households, these fixed obligations can consume a large percentage of their take-home pay, immediately reducing the amount of money available for other needs and wants. Beyond fixed expenses, there are variable expenses. These costs fluctuate from month to month and are often more subject to an individual's daily choices. This category includes spending on groceries, transportation, fuel, dining out, and entertainment. While these expenses are variable, they are not always entirely discretionary. For instance, food and transportation are necessities, but the amount spent on them can vary widely. A household might spend more on groceries one month due to hosting guests or less, another month by eating at home more often. The unpredictability of these costs can make it challenging to forecast the exact amount of money that will be left over. A higher than expected utility bill or an unplanned car repair can easily absorb any remaining funds. Another concept relevant to this discussion is what economists refer to as lifestyle inflation or lifestyle creep. This describes the tendency for spending to increase as income rises. When an individual receives a pay raise or gets a higher paying job, there is often a corresponding increase in their standard of living. This might manifest as moving to a more expensive apartment, buying a new car, or dining at nicer restaurants more frequently. While these upgrades can enhance quality of life, they also raise the baseline of monthly expenses. The new higher level of spending becomes the new normal. As a result, even with a larger income, the individual may find themselves in the same position as before, with little to no money left at the end of the month because their expenditures have grown in lockstep with their earnings. Behavioral economics offers further insights into spending patterns. One such concept is present bias, which is the tendency for people to give stronger weight to payoffs that are closer to the present time when considering trade-offs between two future moments. In financial terms, this means the immediate gratification from a purchase today can feel more compelling than the distant benefit of saving that money for the future. This can lead to impulse buying or spending on non-essential items without fully considering the long-term impact on the budget. A series of small, seemingly insignificant purchases throughout the month can accumulate, resulting in a significant outflow of cash that wasn't accounted for. This is often referred to as the latte factor, where small, regular discretionary expenses add up over time. The structure of modern consumer economies also plays a role. The widespread availability of credit and financing options makes it possible to acquire goods and services immediately and pay for them over time. Credit cards, personal loans, and by now, pay later services separate the pleasure of consumption from the pain of payment. This can obscure the true cost of an item and encourage spending beyond one's immediate means. When individuals use credit to cover expenses, they are not only spending future income, but also incurring interest charges, which add to their overall financial burden. This creates a cycle where a portion of each month's income is already allocated to paying off past debt, reducing the funds available for current expenses and savings. Furthermore, a lack of detailed financial tracking can contribute to the month-end shortfall, without a clear understanding of where money is going. It's difficult to identify areas where spending might be higher than anticipated. Many people rely on a mental accounting of their finances, which can be inaccurate and prone to underestimation. Small cash purchases, automatic subscription renewals, and other minor transactions are easily forgotten, but collectively drain financial resources. Financial education literature often emphasizes the practice of budgeting, which involves creating a plan for how to spend one's income. A budget serves as a roadmap, allocating funds to various categories of expenses. However, without consistent tracking of actual spending against that budget, the plan remains a theoretical exercise, and overspending can occur unnoticed until the bank account is nearly empty. Unexpected expenses and emergencies are another significant factor. Life is unpredictable, and unforeseen events such as a medical issue, a major home repair, or a sudden job loss can impose substantial financial strain. Without an emergency fund pool of savings set aside specifically for such events, individuals are often forced to cover these costs using credit or by diverting funds intended for regular bills. This can disrupt the entire monthly budget, creating a deficit that may take months to recover from. A single unexpected event can be enough to derail an otherwise stable financial situation and consume any buffer that might have existed. The absence of a financial cushion makes a household highly vulnerable to these shocks. Finally, societal and psychological pressures can influence spending habits. There is often a social expectation to maintain a certain lifestyle, which can lead to spending on items and experiences to keep up with peers. Marketing and advertising create a constant stream of desires for new products and services, framing consumption as a path to happiness and social status. This external pressure can make it difficult to prioritize long-term financial goals over short-term social ones. The decision to forego a social outing or delay a purchase can feel like a sacrifice, even if it is a financially prudent choice. This interplay between personal finances and social dynamics adds another layer of complexity to the challenge of managing money effectively. The cumulative effect of these various factors, fixed and variable costs, lifestyle inflation, behavioral biases, credit availability, lack of tracking, emergencies, and social pressures provides a comprehensive explanation for why many individuals and households find their funds depleted by the end of each month.